do I think commercial real estate, well, not commercial real estate, office real estate is going to be a problem? Yeah, we do.
Steve Eisman, who is the senior portfolio manager for the Eisman Group at Neuberger Berman, has seen that there is a problem developing in the commercial real estate market in the United States. But he believes that this issue will likely continue to have an effect on the economy for a considerable amount of time. Since the epidemic, many firms have realized the benefits of allowing their employees to work from home. However, this means that the owners of commercial real estate are not making anywhere near as much as they were in rental revenue. The value of commercial real estate is rapidly decreasing as a direct result of the fact that the rental return is significantly lower than it was prior to the epidemic. However, the owners of these properties do not have any intention of selling them at the present time. Hello and welcome to the Financial Fortune YouTube channel, your trusted source for expert insights into the complex world of finance and investments. In today's video, we have a unique opportunity to dive into the intricate details of the commercial real estate crisis through the eyes of a Big Short investor. Get ready to gain a comprehensive understanding of the factors driving this crisis as we dissect the market dynamics, risks, and potential outcomes. Join us in this illuminating discussion, where we unravel the layers of the commercial real estate landscape and uncover the insights of an investor who foresaw the storm brewing.
Number one, the large U.S. banks are better capitalized and have less risk than they ever had in anyone's lifetime. The European banks, while they're not as well capitalized, are certainly better capitalized than they are. That isn't to say there won't be pain if Credit Suisse goes down, but it's not an '08, thankfully.
So the counterparty risk in terms of transmission mechanism, that doesn't exist to the extent.
No, it does exist.
It does exist.
It's just, I mean, people have been pulling back from Credit Suisse from a long time. I mean, if you hear that the company goes bankrupt, there will be losses. It's not death-defying losses, but it'll be a problem. It's just not. It's not going to take down the system.
In terms of what we've seen in the reaction across the European bank sector, I mean, I guess it's, everybody wants to get out and then figure out
well, it's a little bit of what I'd call PTSD from 2008. Sell and ask questions later, which is not a bad strategy because the news is probably just going to get worse. The news that Switzerland is trying to bail out the company. I mean, to give you a perspective, I remember in 2008 when everybody was trying to get bailed out. If you looked at the U.S., the size of U.S. GDP was many multiples bigger than all the bank balance sheets combined. We looked at Credit Suisse today. Credit Suisse balance sheet is $500 billion. The GDP of Switzerland is $800 billion. So could Switzerland do something? Yeah, they could do something. It's not going to be easy. Not easy at all. The other thing I would say about Switzerland, unfortunately, is they really don't have a lot of regulators. So what they actually know is not, I don't think they know a lot. If you look at Germany, what I've heard is there's like 500 regulators in Deutsche Bank every day.
Right.
I think the number of regulators of the Swiss bank, I could be wrong, is like 250 for the whole sector.
But that statement paired with the notion that Credit Suisse might be too big to save is sort of a frightening.
Well, it's frightening and it's not franking. It's going to be ugly.
Right.
Credit Suisse, I'll say euphemistically, has been a problem child in the investment banking industry for as long as I can remember. And it's always had cultural issues. But, it'll get unwound. It'll be painful. It's only going to be painful for Switzerland. We heard today that they maybe want UBS to take it over. Believe me, UBS does not want to take it over. That's for sure. So I don't know how they're going to unwind it. They probably will have to. I mean, is it possible that they could save them? Maybe. But, the credit default swaps blew out to like 800 basis points. That means you really can't fund yourselves. I heard that they were offering 6 to 7% deposit rates in Asia, and people were still pulling their money. And nobody will be a counterparty anymore. That's more than bad.
Yeah.
That's really bad. So how would Switzerland will deal this?
Do you see that we're in a new era now for regional banks, for what the model will be and how to think about the whole banking structure, the whole sort of business of banking?
It's not a 5-minute question. Let's see, where could I start? Let me start with, and when President Trump passed that bill and raised the threshold from, I think it was 50 to 250. Now, I think that was bad. I think Elizabeth Warren has a real valid point about it. But we looked at the stress test for last year. And the stress test for last year had about a line in it about rising rates. And the rest of the entire stress test was about credit. So even if Silicon Valley had been in the stress test, given what the stress test says, I don't think the regulators would have caught it.
They would have passed it.
And the stress test is basically fighting the last battle. That battle has been won in the large banks. They're better capitalized. Their risk, even with that capital, is much narrower. As Warren Buffett says, when the tide goes out, you see who's naked. This is a different tide. This is not a credit tide. Credit quality in the United States is really good. This is a tide of a mistake, which is some of the regional banks, especially those that have a lot of deposits above 250, bought long-term bonds at very, very low levels and have massive mark-to-market losses. That's why Silicon Valley failed. Also, they failed because they had a very, very concentrated type of deposit base, which has a very big herd mentality.
So it would be very hard to regulate. I mean, even if you apply the stress tests to a Silicon Valley, that may not have detected the interest rate.
The stress test that they had would not have detected their problems.
Right, their problem, because nobody was looking for an interest rate risk on the balance sheet. You're just looking for
credit.
Liquidity.
And that's what the stress test has been for the last 10 years.
It's hard to think of in trying to figure out whether or not you invest in regional banks, you're trying to figure out, well, what can they regulate to prevent this? This is a very specific situation of interest rate risk, which may not come up again for a long time.
Well, we have it now.
We have it now.
And what I would say to that is, so over the weekend, we were thinking, okay, so let's say the government doesn't bail anybody out. So clearly JP Morgan and Bank of America benefit. And it turned out, even though they did get bailed out, JP Morgan and Bank of America benefited. So our first thought was, well, maybe we should buy JP Morgan and Bank of America. And then upon further reflection, we were like, maybe not. Because given what's just happened, all the regulations are probably going to get much more stringent, making the banks much less profitable. And that's not going to be clear for many, many months. So why be a hero? Because you have absolutely no idea what's going to happen.
Would you say that the banking sector right now, with the uncertainty given what will happen on a regulation front, that financials are uninvestable right now?
I would say, we were looking as a team at every single bank. And I would say, given the change in the regulations, the best you can say is you don't know. And if you don't know, you shouldn't play.
Let's say you clear out your position because you're like, we don't know. We don't want to play in this pool. What pool do you go to?
Well, that's not an easy question.
Well, yeah, but I mean, that's
I think what's happening is we're moving from one paradigm to another paradigm. So the paradigm of the last several years has been rates are very low. You're paid to take risk. And you're actually paid to take a lot of risk. So, what did the best over the last 10 years? High growth tech stocks. And what did the best within high growth tech stocks? Super high growth revenue stocks with negative earnings. Okay, so what did the worst last year? Super high growth stocks with negative earnings. Now, are people going to go back to that? I don't think so, especially if rates stay up. So what I think is coming is Tina is dead. Number one, I think you're going to have a much more diversified portfolio. You certainly can leave money in your money market fund because it's over 4%. I'm not sure if it's over 4% tomorrow.
Maybe not
but
anymore.
It's still around 4, which is fine. I think over time, you'll be able to buy some treasuries and buy some bonds. And there are going to be a lot more themes than just tech, infrastructure, bringing in the supply chain back to the United States. And you're going to need to manage risk a lot more than people had. So, people who's outperformed over the last 10 years? Tech investors. The group is now so volatile, I think everybody should take their exposures down. Not that you should invest in tech at all, but you really should diversify more of your portfolio, take down your risk, manage your risk, tailor your portfolios to your clients. One size does not fit all. And given the fact that, my team and my partners and I, we go back every single day. Is there a recession? Is there not a recession? I watch your show. You've had people come on and say there is a recession, and a month later they say it's not a recession. It's It's a very uncertain time because we've never had the confluence of stuff that we have today. And I think that argues for taking less risk.
Right.
But Steve,
Go ahead.
so if we haven't had recession yet, and the S&P never bottoms before a recession, in terms of market sequencing, and the fact that we've seen these credit reverberations and bubbles just start, I mean, how do you see this playing out, both in terms of, you don't need to give us the crystal ball on levels on the S&P.
I mean, let's talk about next week,
Where are
for example. At the beginning of the year, good news was good, bad news was bad. And then in February, good news was bad, bad news was good. And now let's talk about next week. So, I mean, 50 basis points is off the table. So either they're going to do 25 basis points or they're going to do nothing. So let's start with the nothing. I got calls for today that, well, because of Credit Suisse, maybe the Fed will do nothing, and that's really positive. And my response was, really? You're rooting for a financial crisis so that the Fed won't raise rates? I mean, if the Fed doesn't raise rates, maybe it'll be positive for a couple hours or a couple of weeks, but the Fed won't be raising rates because it's scared. Well, if the Fed is scared, you should be scared. On the other hand, if the Fed raises rates even in the face of this by 25 basis points and says that we still could raise more, then that's like, wait a minute, you're sort of caught between a rock and a hard place. Financial conditions have really tightened, but you still have inflation. It's not clear either move is good.
I want to go back to the ramifications of the regional bank fallout. You said you wouldn't want to play given the uncertainty there, but does that also mean that you wouldn't short anything? And does that also mean that you're not also looking at some of the ripple effects, perhaps maybe on commercial real estate, if they have less access to capital because of tighter?
I mean, I don't want to talk about individual shorts.
Sure. Okay.
Do I think the banking sector is still a short? Well, it's imploded. So, I mean, would you want to short some of the bank stocks after some of them are down 60, 70%? I mean, got to have a lot of guts to do that. Probably better just to mostly stay away. I mean, do I think commercial real estate, well, not commercial real estate, office real estate is going to be a problem? Yeah, we do. We think office real estate, but the way these things unfold, it takes a long time. I think what the catalyst will be, it really depends on each company when their debt rolls over. If somebody bought that building 2 years ago with long-term debt at 3%,
right,
and let's say it's 5-year paper, and in 5 years it's going to roll over and it's going to be 7%, that's not good. But it really depends on each building and each company how much debt they have rolling over.
As we conclude this enlightening video, we're left with compelling questions that prompt us to think about the future of commercial real estate. How will the ongoing crisis impact different sectors within the market? What strategies can investors employ to navigate these turbulent times and potentially seize opportunities? What lessons can we draw from the experiences of Big Short investors to make informed decisions in our own financial endeavors? The insights provided by seasoned investors can serve as valuable guideposts in times of uncertainty. Stay tuned to the Financial Fortune channel for more expert analyses and discussions on the ever-evolving landscape of finance and investments. Remember, understanding the market intricacies equips us with the knowledge to make prudent decisions. Until next time, may your financial strategies be grounded in foresight and resilience.